Welcome back to The Explainer. Today we are looking at an absolutely explosive market shock that just sent Bitcoin flying straight past the $72,000 mark. We're going to break down this massive power-up phase using the latest data, the charts, and the on-chain metrics. And honestly, we've got it all presented in this incredibly dynamic, vibrant anime visual style today, so you can see exactly how this whole thing unfolded. Okay, let's just dive right in. $3.1 billion. That is the jaw-dropping size of the short squeeze that just rocked the crypto market overnight. Billions of dollars in bearish bets, completely wiped out in a matter of hours. So you might be wondering, how did we get here and what exactly triggered this massive cascade?
Section 1. The Awakening. Bitcoin shatters the 72K resistance.
Just look at this staggering metric from Glassnode, a 5.8 standard deviation gain. To put that kind of crazy math into perspective, Bitcoin basically gained roughly 15% since Monday, hitting $72,207. According to the data, this is literally the largest daily upside volatility shock the market has seen since late 2023. It wasn't just some gradual climb, it was a sudden, violent move upward.
Moving on to Section 2, the power sources. What actually ignited this surge?
Well, we've got dual engines driving this massive momentum. We're looking at a huge macro catalyst on one side, colliding perfectly with a political catalyst on the other. On the macro side, the U.S. Treasury injected some absolutely crucial liquidity into the bond market. And on the political side, we saw sudden legislative push out of Washington regarding the crypto industry. Let's look a bit closer at both of these engines. Let's trace this timeline to see how things built up on the macro side. You see, the 30-year U.S. Treasury yield had recently hit 5.34%, right? That makes borrowing super expensive and usually hurts risk assets like crypto. But on August 19th, the U.S. Treasury stepped in. They announced they'd be doubling their planned long-dated debt buybacks to at least $4 billion per operation starting September 9th. This intervention instantly pushed yields lower, eased borrowing costs, and immediately fueled a massive appetite for risk assets.
Right as that macro environment was shifting, the political scene threw in the second spark. President Donald Trump hosted executives from Coinbase, Ripple, Kraken, and Robinhood at the White House. The main goal? Demanding the swift passage of the Clarity Act, which is a bill designed to establish clear regulatory oversight for digital assets. During this meeting, the idea of a strategic Bitcoin reserve and expanding overall government crypto holdings was also floated. Now, regardless of where you stand politically, the market viewed this high-level meeting as a very serious momentum shift toward regulatory clarity.
All right, Section 3, the epic clash, a historic short squeeze.
Now, for any of you newer to market mechanics, a short squeeze is a fascinating and pretty brutal phenomenon. When traders bet that an asset's price is going to fall, they take a short position. But if the price rapidly increases instead, they are forced to buy the asset back just to cover their losses. This forced buying creates a massive feedback loop, pushing prices even higher, even faster. It's essentially like throwing jet fuel directly onto a fire. And wow, the sheer scale of the wreckage here is just staggering. Take a look at the vibrant colors on this chart showing the fallout. Over a single 24-hour period, between $3.1 and $3.4 billion in total bearish positions were wiped out. Bitcoin took the absolute brunt of it, with about $1.8 billion in liquidations, and Ethereum shorts followed right behind, seeing nearly $1.2 billion destroyed.
To really put the extreme, fast-paced volatility of this squeeze into perspective, we have to look at the single largest casualty. One massive $48.8 million Bitcoin position on Hyperliquid was liquidated in a flash. The sheer volume of forced buying we are seeing makes this the biggest single-day short liquidation event in crypto history. Entire portfolios literally vaporized.
Section 4. The Reinforcements, a flood of institutional capital.
Over just a brief three-session window from August 17th to the 19th, U.S. crypto exchange-traded products, or ETPs, recorded a spectacular $1.3 billion in net inflows. This donut chart breaks down exactly where that traditional finance money went, and you can see it is heavily weighted towards Bitcoin. Bitcoin captured over $1 billion, which is 77.4% of that demand. Ethereum funds pulled in a respectable $289.1 million, while Solana saw a much quieter $4.1 million.
And leading that charge, BlackRock's IBIT fund alone scooped up nearly $600 million of this, $588.5 million to be exact. Wall Street is aggressively buying into this breakout.
Section 5. Altcoin rotation. Capital flight to higher beta.
This table shows the rapid-fire rotation happening downstream. Ethereum surged over 18% to hit a 15-month high of $2,278. Hyperliquid's Hype token jumped over 21% to trade around $71 to $72, earning the title Coin of the Day after Trump publicly revealed that the CFTC is working to officially bring the platform to the U.S. We're also seeing massive 21 to 28% pops in assets like Ocean Protocol and Pepe. The energy from Bitcoin's breakout is literally radiating outward to these altcoins.
Which brings us to Section 6, the next challenge, overbought risks and regulation.
Let's pivot to today's regulatory landscape. Today, August 20th, 2026, the U.S. Commodity Futures Trading Commission is hosting its inaugural Innovation Advisory Committee meeting. This is a highly significant 3-hour public session covering crypto, AI, and prediction markets. While they aren't voting on immediate rules today, they are evaluating enhanced oversight of digital asset spot markets right as Congress is actively debating granting the CFTC expanded authority, and the market is watching closely. Following that White House meeting, prediction market odds for the Clarity Act passing in 2026 jumped from 19% to 24%.
So, with all this intense regulatory optimism and billions in traditional buying power, we really have to ask, is this market running a little too hot right now?
Well, if we check out the technical power levels, and by the way, I am loving the smooth vector animation style we've got going on in this table, the answer is a resounding yes. This shows the Relative Strength Index, or RSI. Generally, anything over 70 means an asset is overbought. Bitcoin's daily RSI is sitting at 78.54. The hourly is a highly overextended 82.62. Ethereum's daily RSI is at 82.8. These indicators are basically flashing warning red, telling us this move has been incredibly fast, very one-sided, and a pullback is a very real risk.
And you know what? We are already seeing the reaction to that. Short-term holders have just sent more than 44,300 Bitcoin straight to exchanges. Why are they doing that? To lock in their profits. This creates a massive, looming wave of potential selling pressure hanging right above the current price. So here's the ultimate setup right here, the boss fight. On the left side, you've got the structural bullish case. Bitcoin broke out and is currently holding above the critical 200-day EMA resistance, near $71,719. If it holds, the long-term posture target's $75,000. But on the right side, the bearish reality. That historic squeeze that provided all the forced buying, that's over. The technicals are severely overbought, and a massive wave of profit-taking is actively hitting the exchanges.
Which brings us to the absolute bottom line for today, as this quote perfectly summarizes. The continuation of this rally rests entirely on whether organic, fresh, spot market demand can step in quickly to absorb this massive profit-taking wave. The leverage has been completely cleared out, the forced buying momentum is drying up, it is entirely up to the actual spot buyers now.
Which leaves us with one final, massive question for today's explainer. Now that the rocket fuel of forced buying is gone, will fresh institutional and retail spot demand step up to defeat the bears and hold the line? Or is a massive, highly volatile correction inevitable? Keep a close eye on the volume today, because the real test for $72,000 begins right now. Thanks for joining me, and I'll see you on the next explainer.